Hello everyone and welcome to this week's FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Sorry for the slight delay there. There was just, we were just waiting an announcement on my favourite subject, Brexit. Theresa May just announcing that she will propose a vote on no deal Brexit or an extension of Article 50 in the event that Parliament rejects her deal next month. This is obviously to appease those within Parliament that are hoping to force their hand and force an extension if a deal isn't agreed by what was proposed to be the 13th of March, or even try and adapt that date to make it sooner. So that announcement has just now come out. Obviously, this was speculated on earlier, so we'll see what type of market reaction that had. Like I say, that's very much just happened now. So we'll see what action that's had on the charts soon. Obviously, sterling is really flying today already. A lot to do with that, to be honest. But let me introduce myself. Let me get the webinar underway. Just wanted to explain the slightly late start. And also excuse my cold. My voice is very much off, very much under the weather at the moment. And just hoping to power through. But obviously, when we're talking about a platform which relies 100% on voice, that doesn't bode well. So I'll do my very best, and apologies in the meantime. So yeah, my name's Craig Erlam, Senior Market Analyst here at OANDA. Thank you all very much for taking the time to join us. In these sessions, we will take a look at some of the major macro stories which are influencing the markets right now. We'll take a look at the economic calendar week ahead, and we'll also have a look at a bunch of charts. And the great thing about these sessions is you're always welcome to ask any questions along the way. If there's any charts which I haven't touched on, then I will try and cover them for you. And again, please feel free to ask all questions, and I want you guys to find this as useful as you possibly can. Hopefully, you should be looking at the OANDA MarketPulse website on your screens right now. This is where myself and my fellow analysts post our content throughout the day. You can see the most recent one is the piece I actually just posted on the sterling rally on the back of those Brexit stories. And there's obviously other content as well, including my own appearance earlier on the day on Jazz FM. Something we do a couple of times a week, chatting about the markets. So please do check that out if I am just pushing my own content, as it were. But this is also on the website where you'll find the economic calendar just about here. On this screen, I've broken the calendar down by those countries which will have an impact on the currencies which I've selected for this webinar. And I've also done medium and high tier data because I'm just not interested in all the economic releases. That means that a couple will maybe missed off, but if they are, then apologies, but you've got to narrow these things down somehow. And when we're looking throughout the week, I think the first thing that stands out is there is plenty of economic data releases. The major question here is, are they going to be as impactful necessarily as they would otherwise be? I'll touch on some of the more macro stuff when we're going through the charts, hopefully helping to explain it. But I'll focus in this small section now on the actual indicators, the releases themselves. So in terms of what stands out for me here, the one today from a non-political standpoint is the inflation report hearing. We heard from Mark Carney earlier in the day. He appeared before the Treasury Select Committee. This is a quarterly event. Comments on the inflation report, on their expectations, on their assessments on the current environment. Needless to say, there wasn't too much of a surprise here. The Bank of England very much peddling the same line as it has done for quite some time, that Brexit creates a very clouded outlook, that the economy would be significantly worse off in the event of a no-deal Brexit, particularly in the near term, and that interest rate policy ultimately depends on what kind of deal we secure, if any, that interest rates could rise or fall in the event of a no-deal Brexit, depending on when they weigh up the economic impact versus the inflationary impact. Of course, we saw in the aftermath of the referendum, for example, what kind of an impact a swift currency depreciation can have on the inflation numbers. At the time, the Bank of England deemed it not necessary to raise interest rates, but in a situation where that was more severe, then they may deem the inflationary impact to be a greater risk than the economic impact. Hopefully we don't get that there, because as we know from examples in other countries, last year, for example, in Argentina, in Turkey, for example, this may in the longer term be the best solution, but in a shorter term, the economic consequences can be quite devastating. And so this is the type of situation you want to avoid. They did also confirm that this is the least likely option in the no deal, that in a no deal scenario, they believe that the most appropriate response would be an interest rate cut to support the economy, but it's not something they can take off the table. But all of these are lines which we've heard before, so there wasn't really anything surprising in the actual hearing itself. And again, like I say, that's no real surprise here. We've just heard from Theresa May. I can't give you any further details on it because I've just seen that headline on the way into the room. So there's not too much more I can offer on that, but it will be interesting to see what the sterling impact is. We've got Jay Powell, the Fed chair, appearing later on today and also tomorrow. He will appear before the Senate Banking Committee and the House Financial Services Committee. This is his own biannual grilling from various lawmakers about the job of the Fed. I think this could be quite a fiery affair. We've seen the unorthodox approach that President Trump has taken with regards to the Federal Reserve, commenting on its policy, commenting on what they are doing, which a US president wouldn't ordinarily do. It'll be interesting to see if Republican lawmakers follow suit. These are highly politicized affairs. So while there will be a lot of economic speak, I think there's going to be a highly politicized aspect of this as well. I wouldn't be surprised if lawmakers, particularly those loyal to Trump, do question the Fed's contribution to the economic slowdown which we're expecting to see this year. I don't personally believe that this has been a major contributing factor. We are seeing this on a global scale, and we've got to remember we just saw an extraordinary 2018, which was very much supported by those one-off tax cuts. So irrespective of what the Fed did, this year was always likely to see a bit of a slowdown, but I do expect there to be plenty of fiery questions, and that can in itself, especially with someone who's really shoots from the hip like Fed Chair Jay Powell does, I think this could potentially create a lot of volatility throughout this event. So that will be a real interesting one. The day one is always more interesting than day two, just because there tends to be a hell of a lot of repetition during that time. So that's something to be aware of as well. There is a scattering of data over the course of the week. Things like durable goods orders, always a big one. I like durable goods orders because it gives, I feel like it gives you a real good, a really good insight into both near-term and longer-term economic prospects. Near-term because firms are spending big money now on these big pieces of machinery or technology investment, etc. But also longer-term because they wouldn't, if you were making these big investments now, then it means you're confident in a longer-term outlook as well. So I always find this to be a really underrated piece of data. It can be volatile month on month though. That's the only thing to be aware of. But I think from a trend perspective, I think this is always really interesting. We've got Bank of Canada inflation as well. Certainly one worth following tomorrow. US GDP on Thursday. This is the delayed reading. So we're expecting slightly lower growth in Q4. Again, that's really in line with what we were expecting anyway. And Q4 earnings were very much supporting that kind of view as well. And then Friday, we've got PMIs from the Euro area. And then this inflation data as well from the US. This is the Fed's preferred measure of inflation, the Core Personal Consumption Expenditure Price Index, otherwise known as the Core PCE Price Index. Again, inflation is at target, so that's one of the main reasons why I don't really have a problem with what the Fed's done until now. Personally, actually, I did think in Q4 they could have held off because the idea of 4 rate hikes in 2018 and the potential for none in 2019 doesn't really personally sit well with me. I feel like there was no need to rush that last one. They could have done it in Q1 this year, Q2 this year, and at that point the market may have been a bit more stable. However, we are where we are. And I don't think the damage is going to be all too significant, if at all, if at all, really. So I think that's more of a personal preference type thing. Like I say, PMIs throughout the morning, these can create volatility, especially in a currency like the euro, which is, let's say, vulnerable at this moment in time. So let's move on to the charts. I'll cover the macro events as we go. and hopefully provide plenty of insights. And in the meantime, like I say, please do ask any questions if you have them. Euro's not really changed. Like I say, it remains quite vulnerable. We traded around the lower end of these ranges, like 112.50, 113 area. That was a longer term zone. We did have the one blip below. So I think I said last week, this is the kind of area I'm keeping a close eye on. But if we do dip down to these lows, I'm not going to become suddenly extraordinarily bearish. I do think there is scope potentially still for some dollar weakness. But at this moment in time, the euro is certainly winning the race to the bottom, as it were. We have seen a bit of consolidation, but it doesn't look any more than that. So the upside potential in euro still looks quite bleak. If we were going to put some technical analysis onto this, I'd be looking at this kind of rising wedge, or maybe even maybe a rising wedge again. The top side isn't really too definitive yet, but at this moment in time, that kind of looks like a bit of a rising wedge to me. Rising wedges are not bullish patterns particularly. We're coming up to these kind of 113.80, 114 levels, so that could be quite interesting in the near term. But like I say, I still do think this looks a little bit bearish as far as I'm concerned, more so from a euro standpoint than from a dollar standpoint. Where you draw your fibs, it's very much personal preference. I like to use, as where possible, the ultimate highs and lows. But if we look at this situation, for example, the upside move is very much lacking momentum on this MACD, both the histogram and the moving average, stochastic, almost confirming that as well, just as we're approaching that kind of 50 to 61.8 fib zone. So potential area of interest here for me. Like I say, this still looks soft, and unless we see a sudden shift in sentiment on the US dollar in the near term, or on the euro side, I don't expect this to change too much. That 55.89 moving average could potentially provide some resistance, but as we say, we've been trading sideways for some time, so the actual reliability of the moving averages, support and resistance, hasn't been too good, which is typically the case, right? Moving averages are trend following indicators, so in periods when we've seen nice uptrends and nice downtrends, then they can be interesting levels. In sideways moving markets, we just tend to chop through them. Excuse me 1 second. That cold's very much coming back to haunt me. In cable, now we've seen this nice pop high. We've seen a break now to multi-month highs against the US dollar, as high as around 132.40 at one point. It would appear, because this break actually occurred earlier in the day, that Theresa May announcement hasn't had too much of a bullish impact on the pound. In fact, we've actually seen it pull back off these highs. So maybe this is kind of one of those buy the rumor, sell the fact scenarios. You can see that the run-up actually started earlier on this morning. And I don't think the Mark Carney comments had anything to do with this either. I do think they were very much he was coming out with known commentary. We have stumbled at these kind of levels at this moment in time. And if we look at the momentum indicators again, the most recent high, like I say, well, we didn't even make a high in the end, so that was kind of stumbling early. This looks like consolidation for me. So while these days don't tend to go in a straight line, I do think we may see a little bit more upside pressure. 133 is the key level here. That for me, though, this is the range that we've stayed in longer term. If we can break through 133, then that's a very bullish maneuver. But I'm not sure we quite have that momentum yet. This feels like a type of story that has an ability to take us to range highs. It doesn't feel like it's the type of story that has the potential to break out of long-term ranges. So just to go into more detail on this, this is quite an interesting week for Brexit. And apologies if you're over in the US and couldn't care less about this. I really wish I was in your boat, to be honest. This is very much one of those things that's now been dragging on for, well, 3 years almost. And I remember on referendum day in June 23rd, 2016, saying the best thing about today is I may never have to use the word Brexit again, and how wrong I was. And so I'll try and keep it brief, but this week, tomorrow, in fact, we are due to have a vote. It was meant to be initially a meaningful vote on Theresa May's deal. That can's been kicked down the road because they couldn't get the technicalities agreed with Europe over the line. the skeptics will suggest that this was not by accident, that she is trying to run the clock down. I find myself among those, but also I find myself among those that say the European Union wants to run the clock down so that there's no opportunity for the UK to kick any deal that they do offer back to Europe for more negotiation. I think the strategy which Theresa May has now adopted is very clever, actually, because now she's putting pressure on all sides. The Labour Party has just been forced to accept second referendum as its effective formal policy in the event that it can't get its own idea of a deal through, which it can't and won't. So a second referendum is now effectively become party policy. And this is to stop further defections to the new independent group, further resignations. They took quite a heavy hit, losing 9 MPs, and there was a risk that that could be more if they didn't commit to a second referendum. That plays very much into Theresa May's hand, because she now becomes the leader of the only party in favour of delivering on the referendum. The announcement which she's made today, excuse me one more second. Very much trying not to cough down the microphone itself. The announcement which she's made today now effectively tries to get the more hardline Brexiteers within her own party on board. The reason being that we're now approaching exit day. Parliament is very much against no deal, so the chances of that getting through, in my view, are slim to none. We have a party supporting a second referendum, and she's offering Parliament, in the event that they reject her deal, a vote on an extension and more negotiation, or no deal. So given that they won't back no deal, then extension becomes the only option. So now the more hardline Brexiteers within her own party are weighing up the possibility of more negotiations with Europe and a longer extended period, one in which public opinion could move away from leaving the European Union, and any extension is always rejected heavily by the more hardline Brexiteers. A second referendum, which I think many of them would be very much against, out of fear of losing this opportunity altogether, which means that the only way to deliver Brexit on the 29th of March, or maybe after a couple of month delay of this year, is to back Theresa May's deal. So she's kind of in an unusually strong position right now. So I think now we are just going to see the clock tick down. So we will have some amendments posted tomorrow. They will be voted on. It's my feeling that, well, I mean, it's always impossible to make predictions actually with this Brexit process. There are going to be amendments posted. John Bercow, the Speaker, will pick those amendments to be voted on, and then we'll see where we are, I guess. I feel like if Theresa May has delayed her own vote on her own deal and made this offer, I feel that she may have done that knowing that she has enough numbers in Parliament supporting that particular position, that any amendments which could be damaging to her deal prospects and the prospects of her government remaining in charge and Parliament not taking control, I feel like she's confident that they will be defeated. So we'll see how that goes tomorrow. Again, these things are always can be quite unpredictable at times, and we are just always learning how this process is going to move. If you're following this closely, it can be quite interesting. It's almost like watching one of these political shows on TV, like House of Cards or something like that, when you start to see the mindset of all the politicians. But I can completely understand that from the outside looking in, or even from the inside looking in, quite often it can be extremely dull. From your perspective, you want to know how it's going to impact the pound, though. And right now, the biggest thing that impacts the pound, for one, we've seen the pound rally on the fact that no deal looks increasingly unlikely. No deal is the biggest economic threat to the UK. And let's be honest, the pound doesn't care about politics. It doesn't care about what kind of deal we get in terms of whether we retain control of our borders. It doesn't care about what kind of a deal we get, whether we can make our own trade deal with India or anywhere else. What it cares about is what is the best outcome economically, particularly in the near term. And that is firstly to remain, which is why second referendum, the prospect of a second referendum, got the pound rallying. Another is avoiding no deal, and that looks increasingly unlikely, which is when we saw this rally here. And ultimately, I think we'll see the greatest benefit when possibility becomes reality. So if Theresa May gets her deal over the line in a month's time, then I think we could see some potential significant upside for the pound. The question is how confident a sterling trader is going to be. How we know that traders can often front run these moves. I think we're seeing it already with the fact that we're at these 133 levels, even though, albeit tiny, that no deal is a possibility. We're well off the lows at this point. It's how quick a trader is going to be out the blocks. What I find interesting here on this chart is that we held up in this 200-233 day simple moving average band, and we retraced back to the 50-61.8 fib zone. We're now through there, so that's just to me that traders are increasingly bullish now about this deal. That doesn't mean we're going to break through 133, but that means for me that we've entered into a new bullish phase, and this is a new bullish phase that we haven't been in for quite some time. Ever since we broke from these highs in April last year, when we broke from the highs and down through this zone, we've not been bullish, I don't think, from my perspective, since then. So now we've broken into a new bullish phase. This suggests to me that we're on kind of the final sprint, or traders think we're on the final sprint. We can see the light at the end of the tunnel, and that suggests to me that the market is turning quite bullish indeed. But again, this is all about timing, and if we see a delay in Brexit and more negotiations, then that could quite easily lose its momentum straight away. Depending, of course, on what that delay is made up of, because more negotiations and still in fighting, maybe in the near term it avoids no deal risks, and that could benefit it, but it does just prolong the pain in many ways. In Euro Sterling, we're seeing a very similar move. We've seen a breakthrough this long-term support. Again, it's a bit of a wide support, but I'm not really interested in how wide the support is. The most important thing is we're talking about mid-2017 onwards, and this zone here around this kind of 86 through 88 has been 87, sorry, has been support. That's all that's important as far as I'm concerned. We have broken below here today. We came off the 50 fib earlier on this month, and we've rotated lower. I wasn't convinced we were going to be able to see a breakthrough here, so I'm quite surprised that we've seen one through just on this news alone. But I guess we'll see whether this is a bit of a bearish fade, a fake out, as it were, or whether this is actually a significant break. In a short-term perspective, we're now testing prior support from the downside. We've kind of got this double bottom here formed from 85.90 through to 86.20. If that breaks higher and we end the day back inside this zone, then that suggests to me that may have been a fake out. If not, if we close the day below these levels, then that could be quite bearish indeed. Because like I say, May 2017, we're talking near on 2-year lows here. That's not insignificant by any stretch of the imagination. Aussie dollar, we're kind of holding up around these levels. We have to remember that Aussie is very much intrinsically linked to China. China, the biggest importer of its raw materials, things like iron ore, etc. And the Aussie's just been so volatile, so unstable, but we continue to hold above these 70-20, 70-80 zone. This long-term support, yes, we had this blip during the flash crash in the Aussie, flash spike in the yen. But we are still holding above these levels at this moment in time. We're consolidating. For me, the momentum is still with the bears, unfortunately, because we're seeing a series of lower highs, and that's not really changing. It does seem that this is just coming under considerable pressure. However, that said, this report of a truce extension between Trump and Xi, I feel, is bullish for this pair. The reason being that throughout the escalation, the dollar performed very well when tariffs were being imposed, because the US was seeing as being more the bigger beneficiary of tariffs, because it would potentially shrink the trade deficit, and the Chinese economy would be more harmed than the US economy. And same applies with other trade deficit, trade surplus countries. So the US dollar performed quite well. So the de-escalation of it and the move towards a trade deal, you would imagine, would have the opposite consequence. Also, anything that's better for the Chinese economy could arguably be better for the Australian economy, and therefore the Australian dollar, which is why we've seen this kind of pop higher on the reports over the last 48 hours or so. My issue here is that we're not even breaking through 72. We haven't even broken through the most recent high. So it does make me fear, to be honest, on this particular currency pair. But we'll see how this plays out. I fear that the downside risk here is far greater than the upside risk. But if we do move to the upside, then 73 is important for me. Prior high, but also the 200-233 day simple moving average. Dollar CAD again is quite interesting. We've seen it pop higher over the last 24 hours. This came after Trump criticized OPEC, called on them to relax or chill. I can't remember the exact terminology, but effectively saying oil prices are too high once again. What's interesting for me, and we're not going to look at an oil chart because this is an FX webinar, but what's interesting for me is that the market really paid attention to him. And the question is why? Did they pay attention because he thinks he's influential on oil? For me, I don't think that's what it is. I think they paid attention to him because he made these comments at a time when oil was very overstretched to the upside. We've seen a strong rally since the back end of last year. We've made solid gains. The rally was losing momentum. We'd just broken through a really important resistance level, but the market was still losing momentum, which I found quite interesting. And then he makes these comments. Oil falls 3%, and I think this was almost like one of those kind of excuses. You see something that's a story that may be slightly oil negative, and traders just get out. We see some profit taking, and that exacerbates the move lower. So we saw a 3% decline in oil. Oil and the Canadian dollar have that link because it's a major oil producer and exporter, and that is why when we saw the oil slip, we saw the Canadian dollar slip as well, and that's why we kind of bounced higher. For me, I really still want to see a break of these kind of 131, 130, 130 because it's kind of this longer term support. But right now, I think if we see a breakthrough 131, this could be quite a bearish signal. We've seen the kind of consolidation. We're still seeing these lower highs. I still feel like this has the potential to be bearish. We may just have to wait a little bit longer at this moment in time. But yeah, I still feel a bit bearish. Maybe I'm just a little bit too involved almost in this now. I'm hoping too much rather than properly just analyzing what's happening before my eyes. Potentially, you could argue we've got a kind of inverse head and shoulders here, which we do. So if we break back above these kind of 133.25s, then that could be a very bullish signal and suggest we're heading back towards these previous highs, which means we have to wait a lot longer yet. If that holds and we rotate lower than otherwise. But again, really interesting charts, I feel, right here. Dollar CAD, longer term uptrend, where you have just seen that boost higher from the pound. Obviously, weaker oil, weaker Canadian dollar really helping this move. 175, I think, is really key here. A, because it takes out the channel. B, because it takes us through previous highs. And we're talking like long-term highs. We're talking like back to June 2018. So if we break through here, then that's a nice little bullish signal. Whether it's actually got the momentum to do so is another question again. But I really like the look of it. We've kind of got this double bottom pattern here, actually, around 172.75, 169.75s. So that could have potentially been a really nice break today. Actually, that could be very supportive. Obviously, a double bottom gives us those possible price projections. This would suggest one of around 300 pips potentially, which is 175.75. I mean, that takes us roughly back towards these previous peaks. So again, you can't always take these very, very specifically. We're back at the highs now. I'm kind of wait and see here. If we can break through here, then that's a lovely little bullish signal. Whether it has the legs to, I'm not necessarily convinced. Kiwi dollar, I mean, this still looks bullish for me. The reason being that we've got a series of higher lows, and that's not really changed. I mean, there's nothing there that suggests to me that we should be in any way really concerned about this. We didn't get the dovish message which we were expecting, or which the market was positioning for from the RBNZ. This is a rough trend line, so I'm really using it more as an indicative type level than anything else. The key level for me here is kind of 69.50 70s. If we break through there, then this is starting to look bullish. But at the moment, we're kind of consolidating. It seems like there's some relative indecision here. If we break through this trend line, again, rough trend line, then again, maybe through 67 would be more definitive at this point, previous lows as well. So see 67 to the downside, kind of 69.50, 70 to the upside. Apart from that, we may just see some further consolidation. But at the moment, I'd say I have a slightly bullish bias here, but it's I wouldn't say there's any conviction behind that. Dollar yen just continuing to trend higher. We haven't yet seen confirmation from a break through the cloud from the lagging line. We kind of sideways stepped through the cloud, which is never really convincing to me. We've hung up around the cluster moving averages here, the 200, 233 day simple moving average combined with the 55.89. If we can see a breakthrough here around these kind of 111.50s, say, then potentially that could give us that little catalyst, that little push higher. But for me, we seem to be lacking. So we're making new highs, but you look at the stochastic here, lower highs on the MACD moving average. That's just me that we're running out of a little bit of momentum here, just around a key resistance. If we get a catalyst, if we get through that level and that proves to be the catalyst, then these momentum indicators may change. But the chart suggests to me that it needs something to do that rather than there already being something there. Sterling yen again, we are just propelling higher at this moment. Interestingly, we've gone through the cloud with the lagging line, so that could be a lovely bullish signal. We've gone through the 200, 233 day simple moving average, a nice little bullish signal there as well. We did see some profit taking here initially, previous highs and all, but also that kind of level. But we've broken through here, so this looks nicely bullish. This is set up to be nicely bullish for me, potentially getting a bit ahead of the curve. But then we have seen breaks in others. They just haven't necessarily hung on to them yet. This potentially is more significant coming against that kind of risk off yen currency. If we can close the day above here, then I think I like the look of this. Next major resistance here comes around these kind of 149, 150s as well. So there's a lovely bit of room to the top here, potentially. Obviously, as you saw in the disclaimer, this is just my personal view, but the way this has behaved previously, that looks like a really interesting level as far as I'm concerned. We could potentially see some resistance as well around these kind of 147s. You can see in this kind of region here, back here, 147 was key. So that could provide some resistance as well in the near term, potentially see a rotation off of there. But again, it's all about the close here. And we always have to remember that when it comes to sterling, such a heavily political story, it is always vulnerable to intraday reports and stories. Euro yen's just trending high. This is very much just a risk on move rather than anything euro related. Very sorry, I tried to hold that one in. Really didn't succeed. This cold is very much getting the best of me. So we're trending higher in this channel. Nothing's really changed here. There's no really big upward lift. So this chart doesn't really inspire me. If we can move through the 126 70s or so, then potentially this has the ability to crawl higher again. And the next major resistance for me comes around these kind of 127 80s, 128s, maybe 127.50 through 128. And we may reach these levels, but it may just be a really slow grind higher in the meantime. So it's not something I'm getting overly excited about. Okay, on that, rather than continue to cough down the microphone and ruin all of your day, I will call it a day on that. I hope you found that useful. If you've got any questions, please do reach out to me on Twitter. My username is Craig_Forex. Sign up again next week. Next week I'm away, so the webinar will be held by two of my colleagues over in North America. So yeah, so I hope you find that very useful. And again, all feedback is very much welcome. And yeah, apart from that, I wish you all I wish you all the very best of luck with your trading. And I'll speak to you all again very soon. Thank you very much.